What's up? This is the AntiREKT Podcast and I'm Noob. My guest today is the brilliant crypto researcher and investor Willy Woo. He's the inventor of the NVT ratio, also known as the crypto PE ratio. In general, he just has epic insight into the cryptocurrency markets. This conversation was recorded in October of 2017 in a café on the island of Bali. We discussed the workings of Bitcoin, the protocol economy, privacy, sovereign individuals, and much more. Enjoy!
I'm specifically a cryptocurrency researcher, so I'm trying to find the underlying, it's new ground, right? It's very new. Trying to find the underlying stuff that people haven't figured out yet. Like, if you go to Wall Street on stocks, there's all manner of indicators, calculations that you can do that is a centuries old. Cryptocurrency is new and it's got new things, so coming up with the new stuff that we can start to understand this. Like, people talk about Bitcoin being in a bubble. There's no intrinsic value, and what I'm pulling out is actually there is intrinsic value. Here are indicators. Here are this is the new field of cryptocurrency, and this is what's relevant here. Like, we didn't know how to value internet stocks in the 1990s. Like, price earnings ratios are through the roof. People didn't understand zero marginal costs of companies. What if you can reach the world at zero cost? What does that mean? How do you value this stuff? And the same thing with Bitcoin. Like, these aren't companies. Like, we're just talking here. This is like this is not a company, so there's no earnings. How do you value it? And like, we're showing here that you can measure the throughput on the blockchain and use that as a proxy to utility and showing where the value should be, you know. So stuff like that, and so I publish that stuff. I publish it, and I also invest myself. Yeah, and I run a few projects. I don't know if I have a main one. Like, NVT I use a lot lately, because we're always concerned if it's going to be in a bubble. And I think that's more reliable than a lot of other ones. But I keep making shit up. I use a lot of them in cross, because not all of them are going to be perfect, right? And like, for example, you can see that it's like NVT is right up there, like almost calling a bubble.
Yeah.
And you know, if you looked ahead, you go, oh, it's because bubble's sort of like 1995, and it's, you know, here you would have said, back when it was here, you said, oh, it's going to be a bubble, you know, but you would have said, oh yeah, it's a bubble because I can see it. But the reality is the latest data shows that it's coming back down.
Oh yeah. Because
the price pumped. And price pump created all the transactional activity on the blockchain that pushed it back down, you know, as it was redlining. So, you know, you could easily read it wrong, so it's good to see.
So what is the, like, when is it in a bubble? Is that 95 or when?
It's around 90.
Okay.
90 to 100. It's sort of a grey sliding scale. So it punched through. If 100 would be very safe. 100, yes. 100, yes. And we've only had 2 true bubbles, if you call that one a consolidation. Actually, when I did the data behind this, man, that's our first true bubble. That one, true bubble. That one was Willy got bought, right?
Yeah.
And I think there was some definite bullshit happening there based on the underlying data. You know, it was like, what kind of thing pushed it that high?
What data did you look at now?
This kind of shit. Like, you look at all these things that are out of skew. I'm trying to remember, there's other stuff I was looking at that showed that the data was way out of bounds.
Okay.
Like, I don't know, was it volatility one of them? But I'm constantly looking at all these different metrics and looking at the price chart and seeing it, and I knew that this was out of bounds. Not all of these bumps are like the same, you know.
Yeah.
This one shows it very clearly that this one and this one are different from this one and this one.
Yeah.
This had more fundamentals, as was this. When you look at here, I was saying at the start of 2017 to a group of researchers, that this is going to be the bubble that changes the world. And if we're looking at Bitcoin, Bitcoin's not in a bubble. It's ICOs are in a bubble.
Yeah.
You know.
Yeah.
Altcoins.
No use cases for many of them.
Altcoins is like, it's grey, you know. Altcoins is like some use cases starting.
Yeah.
And a lot of altcoins are just shit, right? And I look at the top 10 right now, and you go, shit, scam, shit, good. You know, it used to be like that. Now, more than the majority, like 60% are good, and the 40% are dubious. You know, it used to be 80% were dubious. You know, look, if you look at things like, I don't know, what is it? These like Monaco, 10x, like token card. These ones that are like over the night they launch a debit card, and they're valued at 100 to quarter, 100 mil to a quarter of a billion. Yeah. It's like, what deserves that valuation? Yeah. Nothing, absolutely nothing. Yeah, you know how many?
Earlier, like small shitcoins would do that. Launch a credit card with maybe like $5 million cap, something like that.
Yeah, they were terrible. Yeah, and there's nothing justifying that. But then you look at the underlying protocol coins, like you know, Bitcoin, Ethereum, NEM, even Litecoin, Monero. These are coins that fundamental rails you can build shit on, right?
Yeah.
And they're undervalued massively. I mean, look, I look at Monero, and it's like privacy is worth more than 1.5 billion.
Yeah.
Even at 500 million a few months ago, it was worth more than that. And
I heard you in an interview talk about you always invest in a platform, and I know that all of these altcoins, the big ones, are also platforms. But I'm just thinking, if Bitcoin, you know, it's the most secure one, and if you can scale in the layers above,
yeah,
will the altcoins be able to compete?
Yeah, I think so.
Yeah.
I mean, Bitcoin's very good at a few things. There used to be one thing, which is secure store of value, right? Yeah. And immutability. And it's very good at not changing much, but that's changing a bit with all the forks.
Yeah.
But it's starting to do more with SegWit, which is true. You know, SegWit's allowing a lot of innovation on top. And it can probably do a lot of things Ethereum's doing, because you can, you know, plug in RSK as a side chain and run a Ethereum virtual machine on a secure blockchain. So it can pull back, but I don't think it's going to be the one or be all. I think what we're seeing now, I've been meaning to write about this, is the mesh net. If you can see from the last year to this year, a lot of the other coins are catching up, and a lot of the protocols and even coin projects are about meshing the coins together, right?
Oh yeah.
So his example is the Lightning Network makes any coin with a Lightning Network interoperable, right?
Yeah.
So it's actually a protocol for decentralized exchange at millisecond speed. So I can store Litecoin and pay in Bitcoin, or vice versa, right? And then you've got things like ARK. Have you seen ARK?
What?
ARK. It's a protocol coin that's sitting on top of other chains. It's a bridge chain. It has its own chain, and then if you're going to write an application on multiple chains, I can write it on ARK, and ARK's a messaging platform between all the different chains in a decentralized way. So like, I've already implemented this thing where you can send an ARK transaction to the Ethereum blockchain to initiate a smart contract. So you could code an ARK and use different chains for different applications, right?
Yeah.
So that's another meshing technology.
So it all starts working together.
Like, yeah. You maybe you pick Sire as a storage network. You might use Bitcoin as the notarization or factum. You might use Ethereum as, I don't know, maybe your ERC token because it's got wallet support. But you can pick and choose what coin you're gonna, you know, just like when you develop Facebook, it's multiple languages, multiple technologies, right? Yeah, so I don't think we'll ever see the days of 90% Bitcoin again. I think that in a healthy economy, Like, a very simplistic way to look at it would be if you think of Bitcoin as the world reserve currency, which isn't necessarily true. It's kind of a little bit like the world now where we have a lot of currencies that are strong, like US dollar is reserve, but not so strong as it used to be. You've got euro and you're kind of having a basket of currencies that are relevant now. I think maybe we'll have like that. And then you can look at the protocols and the apps as, you might look at the apps as businesses. They're reflective of world GDP.
Yeah.
Right. So the world GDP has a ratio of world money supply. Right. So if we've got $70 trillion of fiat money, and world GDP is apparently like, what is it, 50 to 70 billion trillion? 70 trillion? It's actually pretty close, one-on-one. GDP grows, money supply grows. They keep it pretty constant because there's this ratio that they want to keep. Like if GDP grows high and they don't expand the money supply, it starts to be detrimental to the economy, right? And so in a crypto sense, you look at the money supply, the reserve currencies, and maybe that's Bitcoin, but I think more likely it's going to be the major protocol coins. And then you have apps. And apps are like, I don't know, like token card or...
So you think like the reserve currency is going to be the major, like a basket of the major currency coins?
I was thinking maybe it was Bitcoin. Maybe earlier this year I was thinking Bitcoin has to encapsulate all of the businesses that the economic activity is in. Like, for example, Ethereum did its crowdfund in Bitcoin. What else would you raise in, right? So obviously it couldn't raise more money than the Bitcoin market cap. So like all the activity that you're doing has to fit inside Bitcoin. But now we're in this paradigm where dual currencies, you've got Ethereum and Bitcoin. And so money's being raised in Ethereum and Bitcoin, and that is the money supply in which activities acting under. And eventually we'll have more protocols that are relevant. Whatever people are raising in and transacting in, that's going to be on the left side of the equation, the money supply, and the business, goods and services, which are our apps, on this side. Yeah. And they're going to be...
transactions,
they're pretty much measure the transactions from transaction value or their business, or potentially even their market caps. You could probably do a ratio of all of their market caps and the ratios of the money supply coins, the general currency coins. So
so the Google Trends you talk about, that's like more of a demand measure, right? And then you have like the NVT, and if you can talk about what that is, what it measures, like fundamentally.
Okay, NVT and trends. The trends is tracking users.
Yeah.
Users. So you can actually look at the adoption level, like the number of people pumping in BTC USD is going to be some proportion of the Bitcoin user base. They know to pump that in. So you have a baseline of growth.
Yeah.
And that baseline of growth is the adoption rate. But then sometimes they're going to punch it in more often than others. And there are times when the price is getting interesting, right? Like when there's a price pump, they're checking it every day or every so many hours. So you can measure that against the baseline, and you can see overvaluation, undervaluation, because when there's a lot of searches on that, it's usually overvalued because the price is pumping off the baseline, but the baseline is increasing. NVT is a metric that is blockchain based, it's economically based.
Yeah.
Whereas Google is kind of like having robots scanning the internet for user activity and drawing conclusions from the world's internet usage on Google and getting clues to how many to that growth. It's kind of like sentiment analysis on Twitter.
Yeah.
Right. It's a different way of looking into it. One is studying humans, the other one is studying the underlying economics. Yeah. So, and I mean, NVT is. I guess I could explain how I came up with it. I started thinking about how do you track the equivalent of the valuation of a payment company, right? So if it was PayPal would be how much money you're earning to its stock price, right? And then, that's PE, right? But there's other valuation metrics, which is sales to valuation, right? You can often do sales, like within the same industry. Like if I've got multiple credit card companies and they're all just doing sales, you got their sales metric, their operational costs are the same. So they're a pretty good metric. So I could just look at the amount of throughput that PayPal's doing and then just do a ratio to its earnings, more or less. And Bitcoins, we do know there's transaction throughput. We don't know its earnings, it's not a company, but we know it's transaction throughput, so it's the closest proxy we have to it. And so that's all it is, really. It's like, if Bitcoin was a payments company, let's measure how much throughput to its valuation. And it
So it's like the fundamental use and the utility of the protocol versus the valuation.
Yeah. You could look at it that way. I could also say, like, show me the throughput, give me a graph of PayPal, the throughput transaction rate, transaction value, and its valuation, and I could probably show you the valuation tracks the throughput very closely. You map them. Like I mapped before, there's a chart there that maps the transaction rate to the network value of Bitcoin. They track almost exactly. And all you're looking for is the slight deviations where one is over or one is under, and that's what the ratio is. When you divide one by the other, it should be a straight line in a perfect situation. But it's not, it deviates, and that's when you pick overvaluation, undervaluation. And it turned out the same as you'd see in PayPal, that early on in high growth, it deviates. It's overvaluing it because there's a lot of future speculative value, and then as it matures, it's more market overvaluation, and that's when you get bubbles. Or undervaluation too, because you can actually see where it's a great time to buy. You can see these dips there. You could buy in there, you could buy in there, you could buy in there. These are all excellent points to buy in. And people will call this a bubble, but it's not. What we're seeing is disruption. We're doing this S-curve adoption, and what we'll probably see is this with fiat cash. We're going to digital currency, and so there's a phase shift. And what we're seeing right now is 25 years of industrial age transitioning to post-industrial age. And the internet's almost finished. The final part of completing that cycle is digitizing money, which was a scientific breakthrough we had with Bitcoin. And now we can stream money, we can send micro fractions across the world in a millisecond type thing. And that changes the world completely. I could Skype you in Africa, but I couldn't send you 5 cents, right? I could Skype you for free. I couldn't send you 5 cents. Now we can. So that actually disrupts how companies are going to be built. Like ISPs, cellular carriers, it's all because of the billing system. When you can start to stream money at a micro level, you can build Wi-Fi routers, can be our own internet. They can hop through a mesh net, and you can remunerate everybody for that data transfer. So you can turn everything inside out again. And so when this completes in the next dozen years, everything's changed. Big companies are broken down, new companies are arise, money becomes digitized up, and fiat money is going down like this, and it'll change the way countries operate.
That's
Here's what I was saying about the apps and the underlying rails, the protocol coins. Yeah. So here you can start to own a slice of the world GDP, because the world GDP in the future, well, it already is. All the internet companies are becoming a huge part of the GDP. We can't get an access to that part from late into the investment via stocks. Here we can, the future companies are going to be built under the protocol stack, and you can own a slice of the protocol, and the protocol operates on the token, and it becomes the currency to operate on. So if you invest now, you're investing early for a slice of the world GDP that's going to sit on top of it. Yeah, it's just like I'm buying the internet. Anyone who runs on the internet, I get a slice of it. And anyway, I was just going to complete by saying this is Sharpe ratio. It's a measure of risk balanced with the reward. Like Bitcoin's a very high risk investment. You could see that early. It was a crazy wild swings, but over time, it's getting more and more stable. But the returns are reducing as well. But like you can see right now, we're at the return levels of when you got involved in the 2013. It's higher than it's ever been. These are the traditional. If you're in US stocks, you're up here. If you're in gold, you're up here. You know, these are the return ratios for the amount of risk you're taking. So in terms of compared to that, for the amount of risk you're taking, you're getting massive return. Yeah. This is actually when you get down to it, if you get into this for any more than a year, you starting to come to this point where owning Bitcoin is an act of sovereignty.
Yeah.
And you start to really understand what that means. Most people don't really get that, but once you're in control of your own money, no one can print more of it, no one can take it off you, no one can block your transactions. Right, so the governments are locking down, and on the other end we've got this new technology where everyone that it touches are concerned, and we got our own currency now. We have our own privacy measures. When you get into this, you learn about protecting your keys, protecting your identity. There's a book, Road to Ruin, James Rickards. He was working at one of the top hedge funds. They manage sovereign wealth funds worth multiple trillions. They manage the wealth of countries. And he talks about the systems that's been rolled out since the 2008 crisis. And essentially, governments, particularly US, has locked down on all financial markets. And the last thing that they don't have lockdown on is cash. So that's happening now. They're digitizing cash. And at that point, when it goes all into digital money in bank systems, you don't have control. And it's already in place that if you have money in a bank, it's actually their money. It's an asset on their ledger, and they do have the right to take it when they want. Like that happened in Greece, Cyprus, Balins. They said anyone more than 100 grand were taking the top, above anything above that. And that policy is rolled out to every single bank in the world now. So your money's not yours in a bank. This is the first bearer instrument since they outlawed it back in the... Bearer instrument is whoever holds this piece of paper or whatever owns it. Alright? And I can give it to you, and there's no intermediary it's kind of like cash, but you can hold billions in these things. Whoever's got it, I give it to you, they've got it. Bank can't block it, right? So that got outlawed. Other than cash, which is bullshit, because you can print more of it, and now we've got... kind of left with gold and cryptocurrencies. But cryptocurrency is very powerful because it's invisible. Yeah. It's a string of numbers. You can memorize it. Yeah. You can cross the border memorizing it. Bitcoin basics is it's just a notebook. You know, money these days is just a notebook. Jacob owes me a buck, so it goes down on a notebook. -1 + 1 will, right? That's what the bank does. It's just a bunch of transactions saying this is what you owe and this is what you owe. And Bitcoin's exactly that. It's just a notebook, but it sits in the cloud. And every single transaction sits in the cloud and everyone's got a copy and no one's allowed to write to it without a whole lot of work being done. It's all set up so no one can write a fraud into that notebook. And that's Bitcoin in a nutshell. So every transaction is visible. So we're just starting to figure out how to do this privately without it being visible. So I've been in technology for a long time, and then when Bitcoin happened, it was like, oh fuck, I've seen waves hit. I saw the internet, I saw mobile, and I saw cryptocurrency as a new wave. And so I just dived in deep to study it, And that's what the only way you can do it is just to immerse yourself.
It takes a lot of time.
Yeah, it takes a lot of time, and it engrosses you, and there's no way you can learn it out of the book because the books haven't been written yet. It's too new. So and then if you can study it enough, you get to change that industry. You get to make a footprint. And that happened in the internet, that happened in mobile, and now we can do it again. It's been store of value before it's payments. Right, so this is the life cycle. Vinny tweeted this. First, it becomes a speculative instrument. Secondly, it becomes a store of value. Lastly, when store of value is stable, very low volatility, it becomes payments. It's the very last thing. So actually, we're in a phase of transitioning into a store of value from speculation. And the funny thing is, this ratio works at store of value level and even speculative level. Like, the more speculation you get, the more transactions you see on the blockchain.
Oh yeah.
And the more people that enter Bitcoin as new store of value holders, each one has to activate with a transaction to get it into their wallet. Yeah, transactions are a measure of new holders coming in and new people hitting it. And so all three actually are being tracked by this. The question is, will it be relevant when we do true payments? True payments is off the chain, Lightning Network, all this stuff. Yeah. And that's, I don't know, probably not.
It's harder to measure than the true,
Yeah, you won't be able to measure Lightning Network transactions throughput.
How about the forks? Because I was thinking transactions, are they going off the Bitcoin network? Some of them now.
There's something like less than 1% utilization of Bitcoin Cash.
Yeah, probably. But what about if we have a new fork in November? How do you see that play out?
I think the ratio will still continue. We have two chains that ratio will speak for itself. If it splits evenly, the value will halve, and the transactions should be split accordingly. Wherever the transactions are, that's where the value is. So that ratio should hold.
That would be interesting actually to see if that's how it goes. You can see that on the ratio. Probably.
Yeah, if one's getting more transactions, the value should be equivalent.
Yeah.
If it's 90-10, the value should be 90-10. If it's 50-50, ditto.
So, there seems to be this two visions of Bitcoin in the community. They're like the cash that's transaction based, and then the store of value and more conservative. What do you see as the most important?
I'm pretty sure it's store of value. If you've got store of value, it's a fundamental. So when you talk about transactions, you're starting to talk about either payments or protocol level stuff. You want to run a lot of transactions with opcodes like OmniLayer. You're doing smart contracts on top of it. You want cheap transactions, and obviously you're using Bitcoin for a number of things. One is it's the most secure chain. Right? It's very expensive to transact on that, but Bitcoin has totally got capability of doing both. But if you have cheap transactions with large blocks, you start to compromise. I think you start to compromise the store of value. Like, you compromise store of value with large blocks because you compromise decentralization. And if you have a less or a more centralized network, you compromise store of value because you're now trusting, say, a few key miners or a few key nodes, and they hold the keys, right? So, I've done a lot of study on this. We've got, now that SegWit's activated, we've got 2 to 3 years headroom. Like, we jumped from 100% utilization of the block to now wavering between 80 to 100. It used to be like, it used to be like this, and then it went beep. Have you ever seen your computer when it's like this? It locks up. When it's like this, it works. Yeah. Here it locks up. We've been locking up, now it's back to this. Hits 99%, but never truly locked up. And SegWit right now, swinging 80 to 99%, it's working. And it's 10% adoption rate of SegWit. When we hit 100%, and it's ramping up week by week, when we hit 100%, at the snapshot now, it should drop to 60% utilization of the chain. And that buys us potentially 2 years. In that 2 years, we've got Lightning Network, which is coming out. They've just released the beta of the software. So we've got that coming out in the next few weeks. That'll knock it down even more because now a lot of transactions going off network. And then on top of that, in 2 years, I think we'll have Sure signatures, which will compress, cryptographically compress a lot of the signatures that are in the blocks. So that's another 30% compression. So 60% becomes 40% utilization of the block. That should buy us 3 years, before we're full again. And then in 3 years, we may be needing a bigger block. But who knows, we might have Nimble Wimble, but we've also got side chains. Side chains tag in, and you got like RSK locking in, that's coming in 2018. Now you can have 200 transactions per second on a side chain using Ethereum, EVM, So here you've got both worlds. You've got cheap transactions on a side chain or off chain, and very, very solid decentralized network. So I don't see that choice. I think the choice is to have both or to have one, and the one is a compromise. Big blocks.
The bigger blocks is basically like, bullshit.
I think it's a politically driven agenda by a few players that want to leverage control over the network, and then the network wants to be decentralized without centralized key players. And the centralized key players are trying to grow up power grid.
And some entrepreneurs probably have problems now because of transaction fees, but that should compromise a $1 billion network.
All of the guys pushing for big blocks have empires that they control. So, core devs haven't played a very political game well, but I don't see them having a big. It's arguably, but I don't think they're leveraging dominance on their empire.
No.
And
they have the cyberpunk, values. It seems like.
Yeah, and a lot of people say, "Oh, you're Blockstream, you're empire," but I don't see it. And there's a lot of contributors. Maybe 50 active, and there's only a few key in Blockstream.
It seems like it's the best also, It's not because core is centralized, it's just because it attracts all the best people.
Yeah, I totally, I've done enough study behind the scenes and of all the metrics and shit, and I'm just like, we don't need bigger block sizes. And that's what Core's saying. Core's saying we need bigger block sizes eventually, but not now. And what the choice is centralized before its time, multiple years before its time, or centralized later. I'd be more thinking, let's work on scalability right now, which they are, keeping the block size small, and let's work on a way to increase blocks as we need them, no more than we need them, without having to go through this bullshit lockup and decision making in future. That's the 3 years we've got. We should do that.
And also, the upgrades should come with like they say, a big timeline. So, to make sure everything is okay and the peer reviews are done and stuff like that. This 2x thing.
It's too rushed. It's too rushed. Yeah, it's too rushed, and
it's not only maybe the code works, but will you also like spook a lot of investors if you do it rushed.
I mean, I wouldn't be surprised if they're just looking at bugs right now that will open up vulnerabilities on the 2x side.
It seems more reasonable, to keep the core protocol safe as possible, and then experiment in the scaling in the layers above.
Yeah, I think it's the safest way, and that's actually one of the values of Bitcoin is the protocol is stable. It doesn't keep changing. Which is, Ethereum keeps changing.
It's very opposite in development. Big and fast is short volatility. But that's also how I think about the Bitcoin protocol. It shouldn't be big and fast. Like Ethereum is going big blocks, and they're doing it fast. So at some point, who knows? Maybe it will.
I think Ethereum's going to blow up.
Yeah,
it's a Formula 1 car on a. Bitcoin's an armored truck. It's just bulletproof, keeps going, and then there's Formula 1 cars racing.
Yeah.
And I think the engine will blow.
What the fuck is this? BitConnect?
I hear it's a scam.
Yeah, I never heard about it. And now it's number 6.
Just to prove a point. Solid. Dubious. Scammy. Just a little bit dubious. Which ones didn't do an ICO? Bitcoin. That doesn't count.
No.
Litecoin. That doesn't count. It's a fork. Monero.
Yeah.
3 out of the top 12. I think of Bitcoin privacy as SSL encrypts the pipe, but not the underlying data. If we encrypted the data underlying it, then everything flies and it's much more secure. Whereas Monero is encrypting the underlying data, right? It's like the blockchain is private.
Okay.
Alright?
Yeah.
So Bitcoin addresses, I'll always be able to view the balance in that address. What I'm doing with privacy on Bitcoin is I'm being able to teleport it from value from this address to that address. You can't connect the two, but I can still see the values in all the addresses. Whereas Monero, you can't see the values.
You can't see the value in Monero.
You can't see the value and you can't see the transactions, who paid what, and you can't see what was even being paid here, right? Whereas,
So with the atomic swaps and from Lightning Network, will you be able to swap to Monero and then make a Bitcoins untraceable basically?
In future, when Monero does multi-sig, yes.
Yeah.
It needs to do multi-sig, then it's got a chance of doing Lightning.
Okay.
Bitcoin, when it does privacy, you can see the addresses and what it holds, obviously. You can see the amount leaving and entering those addresses. You can't see where they went, right? Whereas that's a Lightning Network or Tumblebit, right? With Monero, you can't see where it went. You can't see what's leaving or entering, and you can't even see the balance. So that's fundamentally private or encrypted versus, we're just doing Bitcoin, just making a privacy shield in the transfer.
Yeah.
But I can still look at the hackers hack the repositories. They hack Amazon. They don't hack the pipe, right? I can hack Amazon and get everyone's privacy information on their database, just like I can read all the addresses and still do a reasonable deduction.
So, for example, if you post your Monero address somewhere, people can censor you, but they can't see what you own.
They can't see what you own. You can only reveal to them what you want by giving them a key to see that transaction actually happened. And I tell you, when we're talking about it doesn't get much use, these altcoins, Monero gets a fuck ton of use.
Yeah, probably.
You just look at the on-chain transaction volume. I don't know if you can actually do that, but you can see the trading volume, that's high.
Yeah.
And you can just see every transaction through Monero is not... Yeah.
I'm sorry, I'll bring your bill now. I want to check it. You want order with my
Okay.
for that.
Thanks.
What do you think about the coming of decentralized exchanges like
Huge.
Yeah.
Like, I'm an investor and advisor to Exodus, right?
What?
Exodus.
Which one is that?
It's a wallet. It's kind of like the Mac experience of the blockchain world. And it supports 29 different assets.
Okay.
And it uses Shapeshift behind the scenes to transact. It charges 1%. It's pretty expensive. But I see that as huge, because what you want to do is you don't want to try and control the internet. Right? That's like trying to control the decentralized exchange.
Yeah.
Like Google's trying to control the internet, Facebook's trying to control the internet. All these players are trying to control the internet, but what you want to do is control the gateway into the internet, right? That's why Google had to put out an Android phone. That's why Apple was in a strong position, because when your interface is through the mobile experience, you can broker what service you use on the internet. I can cut out Google. I can cut out Google Maps. I can cut out whatever.
Because you have the users, right?
You've got the users. You've got... So the general thing is you want to be as close to the user as possible. Like, the browser war was that, get close to the user. Then the mobile war was get closest to the user, and eventually the brain implant is the closest. And so in the blockchain world, the wallet is the closest to the user.
Yeah.
And so when you've got the mind share of the user base capturing a good experience, you can dictate what service. You can make or break what exchange, decentralized exchange you choose.
Oh, yeah.
For now, Exodus is using Shapeshift. But if there's a protocol-based exchange like a Lightning Network or any one of the number of decentralized protocols coming up for exchanges, they can choose. And they can use all of them.
Yeah.
You know? And they can like, I'll use all of them to get the best rate, but they have the business and they broker it. And they become, you know, like how Poloniex used to be. If they float on Poloniex, the coin would pump. They say, I'm going to use this exchange, I'm not going to use these guys because they're unreliable, whatever. You know, they can actually make or break exchanges because they're at that level. So that's what you want to control, not the back end.
I measure everything, like includes from, like if it's more like cyberpunk culture, it's good to me. And if it's, you know, more like marketing and buzzwords and stuff like that, I won't touch it.
Yeah, there's someone was saying, was it you or someone said to me this week, the highest correlation to long-term success is GitHub commits. It's like a research paper that was done a while back that showed that developer activity was the highest correlation to long-term success, not marketing, not hype, not liquidity or whatever.
It sounds right.
So, you know, you go to CoinGecko and sort by developer. And then, and then just go on that metric. It's got everything, so community, whatever, but click on that and sort reverse by developer, and it's quite an interesting picture. And then on top of that, I think I focus on commit daily or weekly commits as well. So, you know, it's pretty, is that sorting? Oh, it's still loading. It's pretty accurate. Like, this is the score, you know, Bitcoin by far the highest, Ethereum closely, Litecoin, so that's pretty close. Zcash is,
Pretty high also.
it punches above its weight, but like if you were to look at this stuff, which is total commits and commits in the last time frame, it's not necessarily as, like, look at Monero, look how active, 180. I'd like to sort by that figure.
The most recent commits.
Yeah, in the last 4 weeks, how much commits they've had, right? That is really high, and that's like way up. That's more than Ethereum, right?
Yeah.
And you scroll up, and then look, Siacoin is doing massive work right now. And
It's also pretty cool. You can see the number of contributors.
Yeah.
How many are working on it?
Yeah. This is really useful. It really shows what's happening. EOS is active, they're still building it, but I don't think that's massive compared to Monero, which is already out there and they're fine-tuning it, whereas EOS, they're building the skeleton, right? And so then you just keep scrolling. I was, like Dash is 52. It's like
That's not a lot.
Monero's pissing all over it and all key metrics other than hype. And so I think Dash is a bit of a scam.
Yeah, it seems scammy actually.
It's a Ponzi funded by its Mastodon network.
So, you can do sort of like comparative analysis in this. Like if you want to invest in the top coins, find the best ones.
Yeah, and you can even, they don't do historical, but I think we did a little bit of work tracking this historically, and it's actually quite predictive. Like you can track the ranking of this, and it's a forward-facing predictor of price.
How do you do that? Like you do it.
You just web spider this every day, get the scores and chart them over time, and then you see the movements.
Can we look at this one? Maybe shows the historical chart or what?
Oh yeah, that's awesome.
Yeah.
I didn't realize.
Yes.
Yeah, man, I'm going to pull that in. This data like this I really love.
Yeah, it's a cool site.
You grab all the data. It's unfortunate that they don't give me... I have to go to GitHub directly to look at the commits and zero in. But, what I like doing is just getting the data, plotting them against each other, and just trying to look at correlations. It's just a very empirical view, and then you go, oh, why is that happening? And then you go a little layer deeper, and usually shit comes out. Or it opens another question that needs to be answered.
You always know what you're looking for. You're just looking at the data.
I don't know what I'm looking for, actually. I'm looking for patterns and trends, I'm like, what happens if I do this? Boom. And you go, whoa, that's interesting.
Yeah.
And then it's like, what does this mean? And it's like, and you kind of develop a thesis behind what it's showing you, and then you'll do another thing to try and prove that's right or wrong, and that might come up with another bunch of questions. Just keep going down this rabbit hole, and every now and then you come up with useful stuff.
Sounds cool. So it's just experimenting actually, and then
I think it's like art, Artists grab other people's ideas and like, well, that's cool. What if you changed it this way?
Yeah.
And then it's like, oh wow, and then it's iterative, and you go, oh, what if I, and it just keeps going.
Yeah.
So, versus no hodlers, and everybody's just using it to transact.
That was what I was thinking about Bitcoin. That Bitcoin's the market cap, network value should be higher in relation to the transaction value, because there's more of a money use case, whereas basic attention to it's not like you want to store your life savings, it's more like a use case thing.
Yeah, as in more like there's a higher store of value use case for Bitcoin, therefore the velocity is lower, therefore the price is higher. Yeah, that's very valid. And you'll see that in that chart earlier. No surprise here. This is M2, which is savings. This is check and credit card accounts. Oh no, sorry, that's check and credit cards accounts. Hold on, wait. This is M1. Yeah, this is velocity of check accounts, credit card accounts. This is term deposit, cash deposits. Okay. Bitcoin is hovering around savings.
Yeah.
If it moves to a payment network, it looks like this. So it's the velocity of long-term savings.
Yeah.
Except in Silk Road days, you can see it peaking in the early days. This was Silk Road. No one was using it as savings.
Oh yeah.
Most people were using it to buy drugs.
Interesting. Yeah. So I know you said that the NVT can be used to track also how many new hodlers are coming in, and track if it's overvalued because of that. But if it's like tracking, if it's tracking utility, how do you account for like the store value or hodler value? Like,
well, like I was saying earlier, NVT, the transaction value tracks all three in unison.
okay,
Speculative use, store of value use, and utility is in transaction.
so what about the people who just hold? Like people just
So people just hold.
yeah.
There's no net value gain if there's no new people coming into hold, right?
Yeah.
So for store of value use to be increasing, you see that in transactions. A new dude comes and he's got to buy some Bitcoin and store it in his wallet. So you'll see that as a transaction on the network. So the more people that come in, and it's the new people that come in that push the value up. So it does reflect transaction value on chain equals. If it was transaction value on exchange, it's skewed, right? Because you can't tell speculation from hodl,
Yeah.
right? But the ones that pull it out of the exchange is hodl.
Yeah.
So it's so all three. When speculation is rife, like right now, you'll see the same thing. Everything goes to the exchanges, and it just seems to balance quite nicely. All three use cases. So I wrote this article for CoinDesk because the editor wanted me to make some market commentary. What the fuck's going on? And I said 2017, after the ETF, was an influx of new investors coming into the space, unlike any we've seen before. They are not technical. They're not like libertarians, cypherpunks.
Like
or
this year? Or do you mean
what's that?
this year?
Yeah,
Yeah.
Q1 2014, 17. All of this was cypherpunks, libertarians, all technically savvy and geeks. Startup tech engineers, all these guys. Here, we saw a new phase of investors, non-tech, market savvy, ex-Wall Street, ex-high net worth individuals savvy with investment, unsavvy with technology, with millions to pump around. They read about the ETF. First time they saw Bitcoin not as drug money, but as legitimate Wall Street instrument. Wall Street Journal was reporting on it, and they needed to get in when the ETF was scrapped, right?
Yeah.
Not allowed.
Yeah.
It should have. I did analysis that showed it should have dropped to about $900. It didn't even get close. It hit this. It's that the dip got bought way higher, and it just kept going up as if the ETF happened. It actually hit the levels the ETF I predicted would happen based on supply demand. And what was that? The explanation was, my explanation without any data was, those guys that was going to sink into the ETF bought it directly on the exchanges.
Totally, yeah.
And they asked all their technical friends, how do I buy? And that's what caused this 2017 run up. And then now we're seeing the last month or so, we're starting to see all the new public after the high net worth, the guys with multiple millions to tens of millions put in money in, that pumped the market cap. Now we've got the noobs putting in their savings, right? Because they've seen the price climb. So that was what I was saying, and I got kind of lambasted because it was like, you're just riffing off, nothing, right? So now I've got data to show this, right? And this is the data. This is one of the data points. We're seeing this is the trend you see of part-time Bitcoin holders. They're working. They're in huddle situations. They don't fucking trade every swing. At this point, you've got the pro traders, the savvy investors, the early hedge institutional money that are ready to shift millions in and out of the trade. And so you're seeing in every pullback, it's exaggerated now because millions of dollars are going back and forth between the two, trading between. Whereas previously, very few people did that. It was more part-time So volatility's going up because of it. And then there's another metric. What was it? That was showing this. I can't remember, but there's two metrics that I'm seeing that's happening that's supporting. Fractals. You remember the three cats in the movie?
Yeah. Look on.
I published that right at the juncture where we had a shift in institutional investors, and because the fractal patterns is sort of like a superposition of everybody's psychology onto a price chart, and you can see the same psychology. And then when I published that, it was also the time where all these investors came in, and the shape changed, the fractal pattern changed. It's a new, like, you know how I showed you the new pattern? It's playing out.
Yeah.
It's a new species. There's a new species in there outweighing, and they're thinking differently. But the thought pattern, the psychology and emotions of the new hybrid is completely different. This is not three cats necessarily, it's something else.
Yeah.
So since Q1 2017, the three cats is out, and we've got this new hybrid psychology. That's showing an imprint of a new investor coming in, new type of investor.
Yeah.
And I can when Bitcoin Cash forked, I was like, fuck, three cats. It's doing three cats.
Yeah.
So it was like the early investors in Bitcoin was moving into Bitcoin Cash. They were reflecting the psychological profile of that kind of investor.
Okay.
Whereas this is a new hybrid of institutional money, and they're not trading Bitcoin Cash.
That's interesting.
These guys are trading Bitcoin Cash because the same fractal patterns on Bitcoin Cash, and it's the same psychological imprint.
So you see that now?
Yeah. I'm gonna write an article to say it's fascinating. Yeah.
That's fascinating. Yeah, you can see that from like patterns like that.
Yeah. You see a lot in the patterns. And then
So are you going to leave Bitcoin when it gets?
Yeah, totally. I'm gonna leave Bitcoin when it gets boring.
Yeah. I have the same thoughts actually. And maybe, the cyberpunks will find another coin to work on.
This is what we've seen is multiple generations of the post-industrial age coming. These cyberpunks invented the World Wide Web. What was that guy's name? That invented hypertext.
Tim Lee.
Yeah, Tim Berners-Lee. These guys were thinking of a vision. They were like doing this shit in the 60s, 70s, And then you got this like the 80s generation of the Bill Gates and the Steve Jobs coming in. And then you got the Googles coming in the 90s when the web, And now, deep into the 2000s, we had the cypherpunks coming into their own, or cryptocurrency. But each one of these is fundamental infrastructure being built for a post-industrial age, right? And so, I think the completion is cryptocurrency. We've got just about everything in place right now. And so, once we've got cryptocurrency, we've got everything we can interact digitally. And then, cryptocurrency then flips everything we built prior to be rebuilt again. We've got to rebuild the Facebooks, but we've got to rebuild the internet, even the backbone of the internet based on these new economic models. So we've got another, we're working on the cryptocurrency rails, and then I think we're going to see a new wave of the apps coming, and the new wave of decentralizing everything.
Yeah.
And then when that's done, it's going to be boring,
Yeah.
But hopefully, I'm thinking...
but after the infrastructure that we see now, growing...
Yeah, we've got apps.
Yeah.
We've got apps.
That's it.
We've got rails. We've got real key... it's kind of funny. We've got digital rails, which will fuel real-world rails, say, Wi-Fi transmitters mesh netting, or... fuck nodes. I don't know.
That'd be cool.
A whole lot of core infrastructure we're using that comms channels, redoing decentralized. Then we've got apps.
Satellites, stuff like that.
satellites. Yeah, it's just like, so that's going to take 10, 20 years, and then we'll be fully in a post-industrial age. So that'll be the age in which we'll see nation states crumbling, right? It's just like, it's kind of like the fall of the knights and the royal empires and the rise of the nation states takes a long time. And then the fall of the nation states and the new digital empires and the highly connected city commerce states on digital blockchains or whatever the fuck it is. But there's this new network that arises out of the web of commerce. And
did you read the Sovereign Individual, the books?
No, but like I've been told that this is exactly what this is written, but I've just come to it from another angle, right? Because I like studying history, and so it's just like we're going to that, and we're going to see all this in our lifetime, you know. And I think by that time I'll be retired. Give another 20 years, I'll be retired. I'll be enjoying life, and I'm just curious at seeing all this play out.
Yeah. That's it for this episode. Please subscribe and rate the show if you liked it. To learn more about cryptocurrencies, go to norup.com. That's NORUPP.com. Here you'll also find links and notes from the episode.